What if I told you that a single tweet could make a nearly bankrupt company's stock soar over 400% in a month? That it could ignite a $2 billion market frenzy and potentially save a company from being kicked off Wall Street entirely? That's not a hypothetical. That's exactly what just happened with Opendoor stock. And the real story is even crazier than you think. To understand the explosion, you first have to understand the company at its center, Opendoor Technologies. Their big idea was to reinvent real estate. They're an iBuyer, using technology to buy your house for cash instantly. No realtors, no showings, no waiting. It sounded great, and during the zero interest rate housing boom of the pandemic, it seemed to work. But when the market froze, Opendoor's model shattered. By mid-2025, the company was in a death spiral. It had never turned a profit. It was burning through cash, drowning in over $2.5 billion of debt, and its revenue had collapsed. The stock plunged to just 50 cents a share, and the Nasdaq had served it a delisting notice. By all accounts, Opendoor was left for dead. And then, the spark. On July 14th, hedge fund manager Eric Jackson sent a tweet. He announced he was buying Opendoor stock. He didn't just say it was undervalued, he made an audacious claim it could be the next 100 bagger. And he compared it to the most legendary turnaround story of the decade, Carvana. This wasn't just a stock tip, it was a narrative, a story of resurrection. And it was exactly what the market was waiting to hear. The story spread like wildfire. Within days, Reddit's WallStreetBets was buzzing. The retail army had found its new target. Trading volume exploded. On one day, nearly 2 billion shares of Opendoor were traded. That's more than 1,700% of the average. The buying was so intense, the exchange had to halt trading multiple times just to handle the volatility. Opendoor stock was officially a meme stock. But as the hype machine went into overdrive, a critical question was being ignored. Was any of this based in reality? This is the central conflict of the Opendoor saga. On one hand, you have the bull case, fueled by hope. They say Opendoor is the last man standing in iBuying after its rivals quit. They point to a forecast of the company's first ever tiny adjusted profit, and they cling to the next Carvana dream. On the other hand, you have the brutal reality of the bear case. A fundamentally broken business model in a hostile market, razor-thin margins, crushing debt, a history of nothing but losses. And that next Carvana story, it's a mirage. Carvana sells cars, a standardized, scalable business. Opendoor flips houses, a complex, localized, and historically unprofitable venture. Carvana had a track record of insane growth before its crisis. Opendoor doesn't. The comparison falls apart under the slightest scrutiny. This is a wild story, and I want to know what you think. Are you Team Bull or Team Bear on Opendoor stock? Drop a comment below and let's debate it. And if you're getting value from this deep dive, do me a favor and hit that like button. It tells YouTube you want to see more analysis like this. So if the fundamentals are so bad, why did the stock keep climbing? 2 words: short, squeeze. Over 20% of Opendoor's shares were being shorted by hedge funds betting it would fail. As retail investors piled in, the price shot up, inflicting massive pain on those short sellers. To stop the bleeding, they were forced to buy back shares at a higher price, which only added more fuel to the fire. And here's the craziest part. The rally, built on a story of survival, became a self-fulfilling prophecy. The surge pushed the stock price high enough for long enough to save Opendoor from being delisted from the Nasdaq. The belief in a comeback created the conditions for a comeback. But in this story, who is the real winner? It's not who you think. While retail traders celebrate, the company now has a golden opportunity to sell new shares at these inflated prices. This raises cash to fund their losses by diluting the very investors who saved them. The retail army may have won the battle, but the company's insiders and early investors are the ones who truly cashed in. So what happens next? History gives us a clear guide. After the frenzy fades, meme stock prices almost always collapse. Gravity reasserts itself because in the long run, fundamentals matter. A business that doesn't make money cannot defy financial reality forever. The Opendoor stock saga isn't just about one company. It's a lesson about the new rules of Wall Street. And we're about to get into the biggest takeaway from this entire event. If you want to understand the future of investing, you don't want to miss this. And if you want to stay ahead of market-moving stories like this one, make sure you're subscribed with notifications on because we break them down every week. This phenomenon is here to stay. The combination of commission-free trading, social media, and a deep-seated distrust of Wall Street has permanently changed the game. It challenges the very idea of an efficient market. It raises tough questions for regulators about where to draw the line between free speech and market manipulation. And it forces every investor to ask themselves, are you investing in a business or are you just playing the game? The Opendoor story is a powerful reminder that in today's market, narrative can be just as powerful as numbers. But it's also a cautionary tale. Thanks for watching. Don't forget to check out this next video on the original meme stock that started it all. See you in the next one.